You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody, that music means it is time once again for what the cool kids call OPR, a.k.a. Options Playbook Radio, the show where we break down the sometimes scary, sometimes intimidating, sometimes just fun world of options into easy-to-understand offensive and defensive plays that you can utilize in your own portfolios. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting The Options Insider Radio Network. And speaking of excitement, I'm always excited when I get to welcome on the actual host of this program, your options guy, Mr. Brian Overby, the senior options analyst over there at Ally Invest. Mr. Overby, welcome back to your own program, sir.
Well, thanks, Mark. I always love it when we get the chance to get together and answer some of these listener questions. I mean, we're approaching episode 300 of Options Playbook Radio, and so I always want to go back and see what the listeners have to say, and that means that we have the opportunity to huddle up.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via twitter.com/options, facebook.com/theoptionsinsider, or questions at theoptionsinsider.com.
All right, everybody, like the man said, it is time to huddle up and answer your listener questions, and the mailbag overfloweth here for Brian and OPR. You guys love it. Let's see how many of you we can get onto the program today. Let's start off. It's a question, but it's also just kind of just some love, Brian. This comes from Dragnet. Dragnet says, "I love OPR!" Exclamation point. Well, we love you right back there, Mr. or Mrs. Dragnet. Love is mutual here on the show. He goes on, or she goes on to say, "Any chance of more episodes than once per week? Maybe a weekly look back on the week every Friday." That's a little confusing. A weekly look back on the week every Friday. Well, Brian, there seems to be a theme to the mail here, is that they want more of the options guy. So how does that make you feel? You got to be feeling the love, sir.
Oh, yeah, definitely feeling the love here. And definitely I love the alliteration with the weeklies, and maybe we should talk more about if we could just fit in weekly options into that comment, then we really got something.
Yeah, I agree. So there you go. I guess they've scheduled you now, Brian, for an additional show every Friday. How's that sound?
All right, I'll see what I can do. I would love to get back. I love doing Options Playbook Radio. It's one of my favorite things to do each week. So I'll see what the powers that be say, and we'll see what we can do.
Yeah, we don't want to tease anybody, but we are exploring some options, pun intended, behind the scenes. Maybe get more Brian into your lives on a more regular basis. We'll just leave it at that for now. A little bit of a tease for you, Dragnet, and everybody else out there. All right, next up, COCL wants to know, when you see that the call skew in a stock is bid over the puts, is that a sign that you should immediately sell that skew? Immediately, crush that bid. It's a good question, Mr. or Mrs. COCL. It's not a setup that you see very often. I'm glad that you highlighted stocks because that's something we see quite often on the commodity side of the fence. So, metals, ags, those types of things will often exhibit a bias to the calls versus to the puts. But in the stock world, in the equity world, in the index world, it's not something you traditionally see, as you kind of rightly point out here. And when you do see it, it's usually in some aberrant scenarios. One of the more popular ones that springs to mind is back in the go-go heyday of Apple, right as it was racing to 700. Everyone and their mother loved it. And usually around earnings season, we would see a pretty hefty bid start materializing in those calls. Maybe not bid over the puts, but they were pretty darn close, particularly for a large S&P 500, S&P 100 type name. It was pretty aberrant. We also often see it in some weird event type stocks like biotechs and others where the quote unquote smart money says, hey, something's cooking. Let's buy up all these calls here. It's very situational. If you just want to dive in and crush that skew, make sure you're doing a little bit of a homework. I would be very leery, certainly to be naked short units in a name like a $3 biotech that all of a sudden had the call skew bid up. But Brian, this is an interesting question. There's a lot of interesting scenarios where the call skew might get a little bit of a bid. What do you have to say here for Mr. and Mrs. COCL? Should they sell that skew instantaneously, sir?
Well, there's no golden book of answers when it comes to volatility, that's for sure. So there's never every single time you see this, then we're going to do this. So it's not always that way. As a matter of fact, if I saw bid up skew to the call side, which is, and I probably should say this for the listeners, part of the reason why this question even comes up is most of the time in indexes, especially in indexes, but also in stocks, you'll see the implied volatility on the out-of-the-money puts be higher than on the out-of-the-money calls, and that's just simple math, and that stocks usually have a tendency to go down faster and more abruptly than they have a tendency to go up. And so because of that, there's usually the out-of-the-money puts cost more than the out-of-the-money calls. And now I find this to be a real interesting question because there was actually something that I was going to tweet out this week. I never got around to it, though, was just in Roku, we saw volatility, exactly what is happening here. Roku got beat up after earnings, and then the stock just started coming back right after the announcement. Stock was down 20, and the volatility skew on the nearer-term option contracts, and I'm even looking at it now, it's still kind of there. The out-of-the-money calls are trading at higher volatilities than the out-of-the-money puts, or at least the same volatilities. And these are not options that are trading like for a nickel. You got to be kind of aware of that, too, is if you're looking at out-of-the-money options that are trading for nothing, well, the volatility and all that stuff kind of just goes out the window. But if you're looking at option contracts that got some value in them, 30, 40, 50-cent option contracts, if anything, I would just stay away from it. I wouldn't be looking to go sell it because, as you mentioned this happened in Apple way back in the day when Apple was driving to be a $700 stock before they split, and if anything, it was a sign that maybe the stock is going up. So there's definitely no, oh, this happens, let's go out and sell that option contract, because a lot of times if you see that skew, I take that more as a sign that, there's a lot of call buyers that are coming in, and that's why it's driving up that volatility. So it might be smart money coming in and driving the implied volatilities higher. And that has seemed to be the case with Roku. I noticed it right after the earnings came out, and Roku has done nothing but really gone up since after earnings, after the big drop, day one drop after that earnings call announcement. So it's kind of odd that came up because, as you said, I haven't seen that in a while, and that actually was happening in a Roku stock. Now, as always, this isn't meant to be a recommendation. Roku's made a really big move to the upside ever since they had earnings. So I just wanted to be aware. But that is odd that we get this question on a week that I actually noticed the same thing that the listener's talking about.
Yeah, everything is timely at the end of the day. And you're right, this is a very circumstantial type thing, and you want to make sure you're aware of what the circumstances are that are causing this, particularly in the aforementioned. When we do see this, it's often in some very cheap name that's probably got some news percolating, so maybe you want to get out of the way of that. But if it's a name you already know and have done your analysis on, and maybe you see some skew, and you would maybe thinking about getting, let's say, along a vertical anyway, this is a way to get into a vertical at a much more attractive rate, then hey, go for it. But if you're just going to go out and blast calls away naked, definitely stay away from that. All right, let's see here. Frankie Nelson. How did Brian arrive at his time iron butterfly strategy? Why not all in the expiration month? Well, I believe, Brian, he's referring to some of your recent straddle trades you've been talking about here, like Roku and a few others on the network of late, where you've been adding kind of some interesting legs to them where you're selling the short leg, traditional iron fly. You do it all in the same month. You've kind of been doing it with the short leg expiring a little bit sooner in a different expiration month. So maybe walk our listeners through how you arrived at that setup for your trades.
All right, yeah, I'm happy to do that. As a matter of fact, I didn't actually really think of it as a butterfly strategy, but it is the iron butterfly. It would be a time iron butterfly. I think that's a decent name for it.
I think that's our fault. I think we coined it in the title for your episode, so we may have coined that term,
which is totally fine but the way that I was looking at the trade is that we're doing a long straddle, and my whole thing is I want to be able to go out a little bit further in time to give time for that long straddle to play out. So in particular, we might have been talking about Roku. Another one that I've looked at it in is Boeing recently, and what we're looking for is there's a lot of news that's circulating, but it's not like a known date that the news event is going to come out. And Boeing is the best example of it because up until those planes fly again, there's going to be speculation on what's going on, how our orders look, and what's happening with Boeing. And it just seems like it's continually every week there's a new headline that comes out on Boeing that drives the stock price somewhere, either up or down. So my concept is I would like more time on my long straddle, but if I go out in time, they get fairly expensive, especially on a high-priced stock like Boeing. So what can we do to try to offset those costs? Let's go out and sell an out-of-the-money strangle against our long straddle, which turns out to be an iron butterfly. But if I do that trade and I'm selling it, the biggest thing that I want to make sure I do is that I'm selling a strike that's far enough away to make me a winner on the straddle if the market does go in one direction. In other words, if I go out and I pay $15 for the long straddle, I want to do at least a 15-point wide spread to the upside or the downside. I need at least that in case the stock does move before those short-term option contracts expire. So it was just a play off of a long straddle more than anything because I did like the long straddle. I liked the concept, and it's not very often that you get solid opportunities to do long straddles, and I never want to do them around earnings because it's just too much of a crapshoot around an earnings report because the volatility is known and it's in the option contracts, et cetera, et cetera. So the iron butterfly is really the time iron butterfly, to me, is more so a long at-the-money straddle combined with a short-term out-of-the-money strangle. So there's about 10 different ways I think you could say and describe this. But the long straddle is the concept, and I just wanted to make it a little bit cheaper.
Got to pay for that premium at the end of the day, listeners. All right, let's be nice to Brian. Let's invite on one more listener here onto the program. We got so much Brian love coming your way. Let's see how much we could squeeze onto the show. Last up, we got the playlist. The playlist wants to know, in what scenarios is Brian a fan of doing ratio spreads? Does it ever make sense to be short units in a trade? So, Brian, the old traditional ratio, buy one, sell two, sell one, buy two, they're popular for a variety of different reasons. They're also called front and back spreads, even though I find for a lot of people those terms are a wee bit confusing. So I like to call them ratio and reverse ratio. But, hey, whatever floats your boat. What do you have to say here for the playlist? When do you like doing ratios? And also, are you ever a fan of being short units?
Short units are always, when you're looking at, that means that you're selling two and buying one. That means we're net short one contract. And when you look at those type of trades, to me, it's one of those things where you just want to lay down until the urge goes away, which is one of my favorite phrases. I very rarely talk about trades with retail customers that would leave them naked short an option contract. So one time that I might do it, though, is if it's actually covered by the stock. So you talk about that's, and I like to think of it almost as a covered call on steroids, in that I will go out, I have a stock, I'm thinking about selling a covered call on it, and I'll sell 2 calls and then buy another call option that I'm going to sell 2 calls to help pay for another call option. And in that instance, it gives you a little bit more upside if the stock does move in that direction. You bring in a credit still because you're selling 2 options and buying 1, but you're not net naked that 1 option contract because you actually own the stock. So it's, I think I've coined it, it might even be one of the episodes in Options Playbook Radio, a covered call on steroids, in that I get more potential upside if I'm correct. I don't make as much if I'm incorrect, but there's a time and a place for everything. So that would be one time where I would do it, where I guess I'm kind of skirting the issue because I'm not necessarily net short an option. But if you look at that trade, it's always tempting to do it because you always say to yourself, well, gee, the stock's not going to go up that much, or the stock's not going to go down that much. But all it takes is one real bad trade, and man, that can just ruin an entire year of profit. So I try to stay away from it. So then the other one is, where are you a fan of doing it? I'm a fan of doing ratios in general when I think that the market's going to be more volatile than not, and that's the biggest reason why you're doing it. If I'm going out and I'm doing a ratio spread, and I will do them around earnings, but I got to make sure in my mind that I think that they're gonna move in one direction a lot. So I got to be fairly confident that I'm doing that type of trade. And so I wouldn't mind doing a ratio for a net credit centered around where the current stock price is at, and just thinking that I'm going to get a bigger move than what the marketplace is implying. So I guess in short, now that I've gone full circle, I would say if I look at the at-the-money straddle around in earnings, and I think it could move more, it's one way that I would play it. Go a little bit further out in time. I don't want to do the 1 week option contract. I'd rather do the 14-day because the time will give you a little bit of a buffer. And I'm just basically, as opposed to doing a long straddle around earnings, which I just mentioned that I really don't like, I would rather do a ratio spread around the earnings, and that would just be a total gamble, thinking that the market's going to move more than what the marketplace is implying that earnings report could do to the stock.
Well said, sir. There's always also the traditional repair strategy when, that's kind of the most common ratio you see out there, which is very much analogous to your covered call on steroids. Same thing. Usually you're trying to make up for some losses. The stock is sold off a bit. You buy the call, you sell 2. On the option side, you are a net short a unit, but you have the stock leg there to cover it. So in reality, you're not naked short a unit. It may look that way from that respect. That's where ratios are also pretty popular out there. Unfortunately, Mr. Bryan, we have come to the end of this epic Huddle Palooza. But before we go, clearly people are excited. They're reaching out. They're loving OPR. They're asking for more. They're sending in questions. If more folks want to join the Huddle Palooza, maybe they want to ask you questions in between episodes. Maybe they want to find out what you guys have cooking over there in the land of Ally. Where should they go? What should they do, sir?
Well, you can always direct your questions to my inbox. My email is theoptionsguy@invest.ally.com. And I want to say thanks for listening. Keep sending the questions in. We'll be back same time, same place next week. And until then, may all the options that you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores.
Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.